Our country had recently attained its independence. We had fought a war with our neighbor. Our economy was in a bad shape, but that never bothered my grandfather, who found peace and his daily dose of financial wisdom in this newly released book, for which he said, "This is the best book on investing ever written." And here we are 74 years later, and the same book gets recommended on ChatGPT, on Google search, and in many YouTube videos by content creators all around the world. But perhaps the biggest endorsement for the intelligent investor comes from a certain Warren Buffett, who calls this book the best book on investing ever written, a phrase that the book's publishers have generously slapped on its cover. So The Intelligent Investor was first published in the year 1949, and the author Benjamin Graham offers practical guidance and advice to investors who are looking to build a long-term investment strategy based on value investing principles. To be very clear, this book does not teach us how to beat the market, at least in the way you and I define it, but in fact this book aims to teach us three powerful lessons. 1. How can you minimize losses in the stock market? 2. How can you maximize the chances of achieving sustainable gains? And thirdly, how can one control the self-defeating behavior that keeps most investors from reaching their full potential? So that's it. Just these three things, and at 640 pages, this book is definitely not a light read. And so I decided to read it for the 7th time, but this time I summarized the most important points from the book so that you don't have to spend a week reading it. And in exchange, all I ask you to do is to hit the like button and to put in your comments so that we can have a healthy discussion about it. With that being said, let's begin. In the first chapter of the book, Graham talks about the difference between investing and speculation. In fact, Graham defines investing as an activity that is conducted through the fundamental analysis of companies, as something where the investor deliberately seeks to protect oneself from serious losses, and as an endeavor where the investor is looking for adequate returns as opposed to extraordinary performance. So any operation that does not meet these three requirements was deemed by Graham as speculative. It's a recurring theme in this book, and the modern day examples of Graham's speculative activities would include things like cryptocurrency, non-fungible tokens, NFTs, GameFi tokens, virtual real estate, some AI related stuff that most people don't understand, etc. Chapter 2 in the book talks about money's diminishing value, which is otherwise known as inflation. It's a concept that you and I know exists in the world, but not everyone applies it. In fact, when talking about it in The Intelligent Investor, Graham uses the term money illusion, which is a feel-good effect, but which mathematically comes to nothing. For example, say you get a raise at work, 8%, which is likely to make you happy and you'll take the family out for dinner. But in an environment where prices are increasing by 10%, an 8% raise is not par for the course. Actually, look at it this way. Say you get two options, an 8% raise in a 10% inflationary environment, or a 2% pay cut when the economy is operating at 0% inflation. Now, most of us, me included, will go with option A, and that's what Graham really means by a money illusion. Net, it's Graham's way of saying that cash is a terrible investment and investors should use stocks and real estate investment trusts to guard their money and earnings from the ill effects of inflation. The next lesson from the book relates to the type of investor you are, and according to Graham, you are either a defensive investor or an enterprising one. So a defensive investor is someone who has a long-term portfolio, who doesn't have the time to research and analyze companies, and they prefer to put their investment on autopilot. Understandably, this is a majority of investors, and Graham's way of building that defensive portfolio is via a mixture of bonds and stocks. In fact, there are 4 steps to this that he puts forth in his book. Step 1, decide on your stocks versus bond split, like a 50-50, 60-40, etc., which will depend on your life situation, goals, etc. So note this, Graham is talking about asset allocation way back in the 1940s. Step 2, restore this allocation once or twice a year, which means if the value of stock suddenly becomes 70% of your portfolio and you're comfortable with a 60-40, then restore this parity by selling some stocks and buying bonds instead. Again, this is classical rebalancing, which is something that very few investors do in a disciplined manner even today. Step 3 is to invest a fixed amount of capital at regular intervals, which is something a lot more people do today, as evident from the growing SIP book in our country. And finally, step 4 is on stock picking, and per Graham, a defensive investor should follow these 8 rules of investing, which ranges from diversification to size of the company, the current ratio, the profitability, growth, companies whose price is within range of its net asset value, which is something I discussed in the video on cash-rich companies, and of course a P ratio which is not higher than 15. Now I have to mention here that some of these rules, which were golden in the 1940s and 50s, have somewhat faded in light of how modern business and valuations work. But if I embrace the principles of systematic investing, asset allocation and rebalancing, and add a layer of ETFs or index funds, then it is my belief that a defensive investor is good to go. While the defensive investor is happy with average returns, the enterprising investor is someone who's trying to beat the market by researching and analyzing companies. Yes, it requires patience, discipline, and eagerness to learn, and of course, a lot more time. And Benjamin Graham isn't wrong when he says in his book that most investors aren't suited for this kind of a setup. Truth be told, I thought Graham painted a slightly negative picture of active investing and generally wanted us to avoid things like day trading, foreign bonds, IPOs, growth stocks, etc. In fact, he wrote a lot about growth stocks and at many places suggested investors to avoid them as their valuations were based on future earnings which are less reliable than current earnings or the company's net asset value. Remember, this was the 1940s and the financial system wasn't as developed as it is today. But that being said, there are 2 lessons in this chapter. The first is a set of stock picking rules that Graham recommends for the enterprising investor. And as we see here, the criteria is a bit more relaxed than the defensive one, but the big addition is that the enterprising investor also has to study the company's annual report and other financial statements. In fact, Graham has written a book on this very subject titled The Interpretation of Financial Statements, which we will review in a separate video. The second lesson I picked was on the importance of price when making an investing decision. You see, no investment is good or bad, but it's the price we pay that makes it an excellent decision or a horrible one. For instance, these are a list of companies, profitable companies whose stock price has dropped massively over the last 3 months. Some, especially the Adani Group companies, are facing deeper allegations, but for some other companies, it is a case of the stock coming to a more balanced price. This is something Mr. Market, and we'll learn about Mr. Market in just a bit, but it's something that happens every day in the stock markets, and as investors, we'll do well to remember Ben Graham's words when he said, "A great company is not a great investment if you pay too much for the stock." One of the best known parts from The Intelligent Investor is this imaginary character named Mr. Market that Benjamin Graham introduced in chapter 8 of the book. So think of Mr. Market as a buyer and seller of businesses, and let's say you own a part of a business for which you've paid $1,000. One fine day, Mr. Market reaches out to you and offers you additional stake in this business for just $800. Now, before you could make up your mind, Mr. Market drops in sometime in the afternoon and offers to buy you out for $1,200. You see, Mr. Market is a bipolar person, which means Mr. Market often lets his enthusiasm or his fears guide his investing decisions, which might seem even a little silly to you. I mean, this guy was offering you $800 in the morning, and by the afternoon, he was valuing the same business at $1,200. In a practical sense, this is pretty much how our stock markets work, with the price of a business changing by 2, 3, 5, even 10% over a single day without any demonstrable difference in the operations of that business. In essence, Benjamin Graham created Mr. Market as an allegory for the stock market's emotional swings and its herd mentality. His advice to investors was to avoid reacting against Mr. Market's mood and to look at a stock not just for its price, but to see it as having an ownership in a business. Now, in addition to an ever-changing opinion, Mr. Market is also someone who would land up every day, and by habit, he would offer to buy us or sell us even more shares without forcing us to act every time he shows up. I mean, think of it like a test match. So the bowlers would bowl 90 overs a day, 6 balls at a time, and there is no compulsion on the person batting to score runs off every ball. He or she may choose to leave any number of balls, and only when a bad ball comes along or if the player feels comfortable will they play at it. In other words, Mr. Market will keep on throwing balls at us every day, and Graham's advice to us is to invest only when the odds are in our favor and when we are comfortable holding onto the stock without bothering about the fluctuating price. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released and also share with you some investing strategies, tips and stories that I continually post in the community section. The chapter on margin of safety, which is chapter 20 in the book, is another popular topic of discussion. In fact, I even did a video on margin of safety explaining the concept and Benjamin Graham's explanation of it. So essentially, the margin of safety is a way of reducing the risk of being wrong. For example, say you have to travel from point X to point Y for an important meeting and it generally takes you 30 minutes to reach there. But because there is always that risk of a traffic jam or a flat tire or some VIP movement, you tend to keep a buffer of 15 minutes, which is your margin of safety. Now, Graham insists that all investors should have some margin of safety when investing in stocks, and for that matter, any kind of security. For instance, let's say the intrinsic value of a stock comes to 100 rupees. Actually, you know what? Let's calculate the intrinsic value using Benjamin Graham's original formula. So Graham uses a combination of earnings per share, its growth rate, and the yield on AAA rated corporate bonds to calculate the intrinsic value of a stock. I must mention this formula was created in an updated edition of the book which came out in 1974, and in my opinion it's pretty outdated. In fact, when I tried it on some of India's more popular companies, the rift between the current share price and Graham's intrinsic value calculation turned out to be absurdly high. Anyways, this doesn't diminish the importance of margin of safety, and it's a concept I use quite a bit, and as a number I insist on having at least a 30% margin of safety before investing in any company. Say someone gives you a gun, a 6 cartridge revolver with 1 bullet in it. So the deal is you pull the trigger once, and if you survive you get $1 million. Now I don't know about you, but I would generally decline such an offer. To which this person, who has probably seen a lot of these Saw movies, comes up with a counter offer. How about 2 bullets and I give you $10 million? Okay, so you don't have to take a decision on this now unless you want to. But what this situation represents is a positive correlation between risk and reward. That is, as the risk increases from 16% to 33%, so does the reward as it goes up from $1 million to $10 million. So this is classical finance, and as per Benjamin Graham, risk and reward are not always positively correlated. Let me explain this with an example. So say you are a middleman and I give you a bulk order for mobile phone covers at 100 rupees a piece. Now you can source these covers from 2 shops, Shop A and Shop B. Shop A is ready to sell you these covers at 40 rupees per piece, while Shop B is offering it at 55 rupees. Now, to be realistic, there is always that small chance of me backing out from our deal. So the question to you is, where is the risk higher? And if you think through it, the correct answer has to be Shop B. After all, by paying 55 rupees at Shop B as compared to just 40 rupees at Shop A, you have a lot more to lose with B in case I turn out to be an unreliable partner. Which brings me to the second question, that is, where are your returns higher? And understandably, it is Shop A that gives you a higher profit margin of 60 rupees as compared to Shop B, where it is only 45 rupees. So to put this together, in the case of Shop A, you get a higher return and the risk you take is lower. And in the case of Shop B, you receive lower returns and you're taking a higher level of risk. This is what Benjamin Graham tells us via the intelligent investor. That is, in case of a value portfolio, the greater the potential for reward, the lesser is the risk in it. Alright, so to quickly recap, the intelligent investor starts off with a comparison between investment and speculation. Then there was a chapter on inflation and the time value of money. Chapter 4, 5, 6, 7, 14 and 15 were on the defensive and enterprising investors. Chapter 8 introduced us to the imaginary yet timeless Mr. Market. Chapter 20 was on the margin of safety and why it is the central concept of investing. And we finished this book summary with an inverse understanding of risk and return, which is the foundational principle of value investing. I think this book has something for everyone, and it doesn't matter whether you are a beginner to investing or if you're amongst the world's richest who said, and I quote, Chapter 8 and Chapter 20 have been the bedrock of my investing activities for more than 60 years. I suggest that all investors read those chapters and reread them every time the market has been especially strong or weak. No one could have said it better, and I, for one, have been reading and rereading this book to remind myself the importance of discipline, the need for patience, and the advantages of having a long-term perspective in investing, making it 3 lessons that remain as relevant and valuable as they were 74 years back when this book was first published. If you liked this book summary, then do give this video a thumbs up. And if there are other investing books you have read and have made detailed notes on, and if you want me to present your research, then do drop me an email. Once again, thank you for your time. Do like this video, do subscribe, do share, and I'll see you 3 days from now. Until then.